What if I told you that the traders making the most consistent money aren't the traders that are chasing the big moves, those big daily time frame swing trades? After talking to some of the best traders of our generation through my podcast, having interviewed many swing traders, many scalping traders, and in both domains, people are finding profitability. But what I have learned after my 9 years in trading and after banking millions of dollars myself from the market and having shown a public track record of my exact performances in my first 4 years of my trading, I in fact was a swing trader. But in the last 3 to 4 years, I've learned something quite counterintuitive, and that is just taking a simplified approach, trading just 2 hours per day and focusing on session reactions and going for very modest targets. I mean, simply just the average session movement. Forget those big monster 100, 200, 500 pip trades. I'm talking about 15, 20 pip trades. And these small moves, these high probability intra-session reactions, in my experience, completely outperform swing trading and higher time frame moves. And most importantly, how many high quality swing trades can you find in a month versus how many high quality intra-session trades can you find in a month? Let me tell you, you can have a great win rate, a great risk to reward, a great rate of return because you have a great trade frequency. And in this video, I'm going to be breaking down to you a specific approach, trading without points of interest with a 50% win rate, what kind of a rate of return you can expect by following a 1 to 3 system only. A 1 to 3 on an intra-session level, something that no one ever speaks about, no one ever trades, but has helped me make millions of dollars and is a very simplified, actionable approach that you can learn from this video and start applying from tomorrow in the markets. So here we can see my risk management operating system. And here this is my AI powered personalized journal where it helps me track certain things, KPIs and performances. What we're focusing on here is not just theory, it's mathematics. I'm focusing on probability, rate of return, and your overall chance of success. And most importantly, how it can impact your psychology, how it can impact your prop firm behavior, and how you can actually take this approach and start to get funded, start to get payouts with the same win rates you maybe already have, with the same risk reward profile you already have. You're just focusing on high quality, high probable zones. And for the sake of this video, I'm not even showing the prime setups, which I've already showed on this channel many times. I'm going to focus on a lower probability setup and still show you how successful it can be with 2 take profit systems. So remember in a previous video, I gave a full liquidity trading guide and we spoke about the many factors we need to consider of the types of inducements and so forth. Make sure you watch that video. But remember, there are certain sections of not POI based trades, and especially here, non-point of interest trades. So a point of interest is basically where most traders are going to be interested, for example, through supply and demand market structure and so forth. And again, I'm completely with that. I'm completely with trading inducements of POIs or trading within the points of interest themselves. That's the preferred way. And those will usually be A or A plus setups. But there's also a category of trades that are B plus setups and B setups, which are going to be without a point of interest. Therefore, you're going to be focusing on an inducement. So we'll be going through all of that in just a moment. But first, I want to focus on the take profit profile. So the 2 systems I want to establish for now is we have a 1 to 3 risk reward full volume. So your full take profit is at the 1 to 3 risk to reward mark. And then the other one is where you have 2 take profit levels. The first take profit level, you take 50% of your volume at 1 to 3 risk to reward. That's your TP1. And then your take profit 2, you take the remaining 50% of your volume at the 1 to 10 mark. So with that being said, this one is going to lead to a 3% gain because you take your full volume at 1 to 3 risk to reward, assuming 1% risk. This is plus 3% gain. This is going to be 1.5% gain at the 1 to 3 risk to reward, 50% volume. That's your TP1 gain. And then your TP2, the remaining 50% volume at 1 to 10 becomes a 5% gain. So when you tally these together, this can actually equal a 6.5% gain. 1.5% plus 5% equals 6.5% when you have both targets met. Sometimes it'll be only 1.5, other times it'll be 1.5 and 5, meaning 6.5%. So these are the 2 risk management profiles. And this is what I want to display to you. So the first risk management profile is this one, is when you take your full take profit level at the 1 to 3 mark. 100% of your volume secured at 1 to 3, meaning you get a 3% gain. So we can see on a $100,000 account with a 50% win rate, what kind of performance do we have, assuming 1% risk per trade. So we know that a loss is going to be minus 1%, so minus $1,000, and a win is going to be 3%, therefore $3,000, and then of course you have break-even trades. So when you have about a 50% win rate and you are getting 3% gain per winning trade, so these are modest stats. These are very modest stats because a 50% win rate is very achievable, and I'm going to show you how achievable a 1 to 3 risk reward really is. We can see our rate of return looks something like this: steady, consistent gains. And by the way, because you can find a intra-session trade 2, 3, 4 times a week, your rate of return is quite rapid. Whereas a swing trader, you might only find a quality trade once every 2 weeks, once every 3 weeks, on the same win rate, on the same risk reward profile, and the same everything. Your rate of return will be drastically slower. So for you to get plus 10% as an intra-session trader, it might take you a month or 2 months. Whereas a swing trader, it might take you 2, 3, 4 months to get the same outcome with the same risk management profiles and win rates. That's the beauty of compounding effects as an intra-session trader. And we can see here with the other risk management profile type, which is taking your first profit at the 1 to 3 and then your full volume at the 1 to 10. So that means a losing trade is minus 1%. So therefore it's going to be a minus $1,000. And then certain trades are going to be only reaching take profit 1. So only take profit 1, which is at the 1 to 3 mark, but you're not going to get 3,000 this time because you're only taking 50% of the volume. So instead of 3,000, it's 1,500 for TP1 only trades. And then certain trades that hit both take profit levels 1 to 3 and 1 to 10 is going to result in that 6.5% gain, meaning 6,500. For the purpose of this demonstration, we are going to have the same 50% win rates, and the winning trades are going to be 75% of your winning trades are at the 1 to 3 mark only, TP1 only, and then only 25% of the winning trades are going to be at the take profit 2 level. So majority of the winning trades are at the 1 to 3. I'm being conservative here, and then the occasional 1 in every 4 will reach your take profit 2, your final target, meaning out of all of your trades, 50% will be losses, 37.5 will be TP1s, and 12.5 will be TP2s. So we can see it's a very normal distribution, very conservative analytics. I'm not going for home runs. And we can see here with these conservative metrics, you can still have a very steady, stable growth rate. Obviously, you'll have certain periods that it jumps because you're getting your TP2, but in the end, you can still get very similar profits to the other one. Here we had a 30% gain. In the other risk management system, we had a 34% gain. So both of them are reasonable, which is why I display both models, because myself, I actually do the split model. But what I can actually recommend is based on the setup type. Let's say it's A plus setup, have a different risk management profile, to a counter trend, lower quality setup, have a different profit taking profile. And by the way, if you want to grab this risk management OS, it's powered by AI. It's got some key components engineered like a lot size calculator. And depending where you are, let's say you're in drawdown, it gives you recommendations like stick to A plus setups only, reduce your risk. So not only does it display your performance and give you an equity curve graph and a trade log so that you can see the key insights that are important, it's also going to be telling you what you should risk on your next trade, what setup type you should take based on your account size and based on your performance lately. It will give you the key things that you need. So this is something I've been using for a year and a half now, something that has helped me a lot in my trading because I can basically outsource all of the psychology, all of the risk management, all of the decision taking, and now it's powered by AI so that I don't have to take these decisions, and therefore I'm less likely to end up revenge trading, FOMO trading, spiraling in a losing period because I can rely on this. This is free to grab. I'm never going to charge you for it. You can have it for the rest of your life and you just claim it through the link in the description. So now coming on to the portion of the trade type itself. In this video, I want to focus on inducement based trades and inducement non-POIs, and we need to see how we validate them and later on how we can actually get into them based on the lower time frame models that we have. So I'm going to do a full top down analysis. Even though I don't spend too much time on it, I'm going to show you exactly how I do it for my intra-session trading. And I'm going to show you some key things that you need to focus on, like average session volatility, average day volatility, and why you should create a strategy around that as opposed to random take profit levels based on market structure, supply and demand trend lines. All of these things are random, and therefore when it's random, you're always going to have random decisions and you're always going to be influenced by your psychology on which decision you pick. This is not how professional traders do it. Professional traders try and make things as mechanical as possible and backed by data. So that's exactly what I want to show you in this video. But first, let's do our top-down analysis, focusing now on the 4-hour time frame. First things we see is that here we had a build-up of liquidity and a inducement high, and that inducement high led to a market structure shift bearish. So we are in a bearish market. How do we know? Because this previous low in the market had a break of structure and we went lower low. So we can see the market is trending lower low, lower high, and lower low. So therefore we have found an external trading range, a dealing range based on the 4-hour time frame, and therefore this can be our equivalent of the daily. We don't need to really look at the daily because we are not in a point of interest. If price is here today, why are we going to be looking at our daily time frame up here, would be saying, or down here? We're going to be looking at what's happening here. That's why I don't really believe in top-down analysis, because I'm not going to hold the trade all the way down here anyway. I'm focusing on a different metric. So therefore, I'm going to quickly glance in this higher time frame to just get a scope of what's going on. The next thing to realize is because I'm within my external range, I'm above this external low and I'm below this external high. Therefore, I'm in this middle period. In that middle period, I need to find the internal structures. So therefore in red, I'll mark the internal bearish structure points, which is internal lower highs and lower lows. Therefore we have internal lower low, lower high, lower low, lower high, lower low, and so forth, all the way down to the ultimate lower low. Then when price reached here, it went up all the way over here. So we had this mixed structure where it neither did a lower high or a lower low. So we do it in blue. And this area failed to make a lower low. So we know it's internal structure. And then eventually price broke here. Now I'm going to do this in green because we had an internal break of structure based on the internal bearish structure that was internal lower high, internal lower low. Now we've had a switch towards bullish. So we've had a bullish break of structure. And then this area didn't go on to make a lower low. We went on to make a higher low. And now we are in a confused area. Why are we in a confused area? Because technically we had a break of structure of this internal zone. So we could be saying, oh, now we switch bearish and we sell from here because we had an internal break of structure, retracement to the extreme, and now we go on to make a lower low. That is one possible roadmap. Another way we could read it is, oh, this is a run of liquidity. Another read could be because we had a bullish switch out here, we had a bullish high. This could be a run of liquidity. And then we could start to have this bullish push out, bullish break of structure from here, bullish break of structure from here. And we could be going on to make highs and continuing maybe all the way to this extreme. So as we can see, we are arriving in this area, and this area that price is right now, price could go on a bullish roadmap or it could go on a bearish roadmap. Here is an inflection point. So when you are in an inflection point, you can't really rely on market structure. You can't really rely on supply and demand because they have mixed reads. So you drop down to a lower time frame and analyze liquidity and immediate trends to really understand who's in control, to know which roadmap is going to play out. So for this area right here, this line I'm going to put, is it a break of structure or inducement? We need to confirm that. And that's going to be confirmed by the outcome. If this was a break of structure, you'd have a lower low, then you'd have a retracement lower high, and you'd go on to make a lower low. Once this has been formed, you know that this was a bearish break of structure. On the other hand, if this was an inducement, then we know price will grab the liquidity here and then eventually have a bullish breakout like it's doing and then continue on bullish. And then we know that this was an inducement. So we don't know which one it is, if it's a break of structure or an inducement. So we wait for confirmation or we read this price action to understand who is in control so that we know before the rest of the traders who really is in control and which roadmap is playing out. Okay, from the 4 hour, I'm going to jump down to the M15 very quickly. And from here, I need to understand POIs and control. So this last zone that had the bullish breakout, it is a higher high. And because it is a higher high, I can't necessarily consider it a supply zone because you don't sell at higher highs. However, I am going to consider it because this area maybe had a break of structure. So it could be a supply zone. I just don't know yet. So we are going to mark it out and we're just going to take the overall supply zone from low to high. And then when I arrive to today's price action, I can see prices tapped into that supply zone and starting to give bearish reactions. What I can quickly see is we don't have any inducements. It's just mitigation, 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 no inducements. Here, just order flow. Here, just mitigation. Here, just another mitigation. Slight inducement, but it's an Asia high inducement, so I don't really focus on that. Here, just another mitigation, and here we have more mitigations. Where is the inducement? So if I'm not seeing large bearish candles, large bearish momentum, large bearish imbalances, and no bearish inducements, this shows me that the sellers are not in control. So even though we've arrived to a supply zone, it's not really a supply zone, it's a higher high. So this could all be a trap, and this is all showing me weak intent. So all I need to see is liquidity to the upside, intention to the upside, and confirmations to the upside following the roadmap. So if we can follow our inducement, time, and lower time frame trifecta of control that I always mention in every video, that's how you can trade against this because the sellers are not in control. It's showing me that the sellers are lacking intent. But when I do look over here to the left, I can see plenty of inducements where we see equal lows, inducement, build up of liquidity, minor inducement. We have this build up of liquidity getting induced, let alone all of this getting induced. We continue on here. What do we see? Build up, inducement. And then what happens over here? Most likely a inducement of a smart money trap. So we can see plenty of signs that the buyers are in control. We keep going on. What's happening here? Build up of liquidity, inducement, push out. All of these inducements have led to pushes out, whereas all of this price action is no inducements. So who is in control? Very simply, we can see that the buyers are in control. And if we can find a buyer's inducement in a POI or not in a POI, it doesn't matter. The buyers are in control, and if I can see that last hand, I look for the Trinity and I can take an intra-session trade. Now, you guys have seen my personalized indicator that I built for myself. That is simply to show my key things of Asia high, Asia low, my key time windows, let's say high of previous day, low of previous day. Another thing that I've coded in is show session pip range. I'm going to turn that on because I want you to pay attention to something. If I look back at the last few days, what has been my average London and New York session? Today has been 15 pips. London previous day, 13 pips. The day before that, 22 pips. The London the day before that is 20 pips. The London day before that is 16 pips. Before that, 12 pips. Before that, 19 pips. Before that, 16 pips. So what we can see, if you go back in history, what is the average movement in the first hour of London? You'll find it's about 15 to 20 pips. And if you take from the London low to the London high on average, it's going to be around 30 pips. So we can start to see that the average session range is around 20 pips. So if London on a Euro USD on average, on a best case scenario, moves between 15 and 30 pips, then it makes sense to take a profit, to take your first profit on average between 15 and 30 pips, because that's your average session movement. And even if you're wrong, let's say price goes in your direction and then hits break even or stop loss, within that average session movement, you could take your profit and be wrong, so that when in your losing trades, you're making profits, or your break even trades, you're making profits, let alone your winning trades. And that's the whole point of taking full volume at the 1 to 3 or taking a partial at 1 to 3. Because if my average stop loss, and I'm going to show you how, if your average stop loss is 3, 4, or 5 pips, that means your average TP1 at the 1 to 3 risk reward is going to be 9, 12, or 15 pips. And those all fall within the appropriate average session volatility. So your average take profit 1 is your average session volatility. This is the perfect way to take a partial, because you're backed by data, you're backed by average price movements, and even if you've got it wrong, you can most likely secure a profit as long as you didn't hit stop loss right away. And when I do an analysis of the New York window, it's the same thing. This one is 19 pips, this one is 15 pips, this day is 28 pips, this day was 20 pips, this day was 26 pips, this day was 8. So we can see the same thing. On average, London and New York move a similar amount. The average New York window and the average London window is about the same, 15 to 20 pips. So therefore, I should be taking my take profit 1 around 15 to 20 pips. And where is my take profit 2, you may ask? Why is it at 1 to 10? Well, if you go back and you check the average daily range, the average daily range is going to align around 30, 40, and 50 pips. That is exactly my 1 to 10 based on a 3, 4, and 5 pip stop loss. So you can see we've engineered a strategy based on average volatility. So therefore, you're not hoping for market structure. You're not hoping for a trend line. You're not hoping for price to go to that next supply or demand area. You're just focusing on the probability of the average session movement. And that's exactly what we coded into this 2 protocols of the risk management profile, where we have full volume at the 1 to 3, 3,000, 3,000, 3,000, or we have splits profits, either 1,500, a partial at 1 to 3, or 6,500 means you hit your take profit 2 at 1 to 10. And that's exactly what we discussed at the beginning, based on 1 to 3 risk to reward taking 3%, or taking 2 profit levels and taking 6.5% or 1.5% based on TP1 only, or both take profit levels. Okay, so now coming into the setup of this day, if I've seen that prices come to a higher high, which is not a supply zone, so could be a trap, and I'm seeing sellers lack intention and buyers are showing inducements, then I need to find a point of interest. So for example, here is a point of interest. This is a higher low that made an internal higher high. Where is another one? We have another one being this inducement right here. It's a big wick, so we have to refine it down, which we can do, but price is not here just yet. But if price arrives here, we refine this. But these are our 2 demand areas. This run of liquidity that led to a higher high, and this area over here that led to a higher high. These are our only appropriate demands for where price action is on this day. What we do know is Asia low is usually a liquidity pool and a trap. So when I refine this area of demand, and I just do it from the last sellers to the first buyers, and I come back to this area, when we can see the reaction is basically on Asia low. What do we see the trap of Frankfurt's being? The trap of Frankfurt is, hey guys, everybody, we have arrived to this demand area, and then we're having a bullish push and respecting bullish push, respecting bullish push. They are showing this trend line. So that is all going to be liquidity, because Frankfurt usually is a trap, and we are inviting in buyers and forgetting that temporarily from a minor inducement perspective, the sellers are in control, and we're getting this minor inducement here, mitigating this zone on the left. So when we see this build up, inducement, mitigation in the London window, we know all of this is a trap to target to this trendline liquidity of Frankfurt and the Asia low, and probably even the demand area. So that's what we see. We can see that continuation on the M1 level in mitigation of the order flow, build up, inducement. That means sellers are in control, sellers are in control, sellers are in control, and all of this build up is liquidity. All of this build up is liquidity that gets targeted eventually. So we see eventually the sellers do take control. And now we have arrived to, where are we? As the New York key window arrives, we have taken out this demand area, and the next demand area is all the way down here. So we are in no man's land. We can potentially take this zone, which is a decisional, and we say, okay, this zone ended up being a trap, and it makes sense. It's Asia low related. Frankfurt showed us it was a trap. We don't trade that one because it's not structurally relevant. This area is not as structurally relevant as a decisional and an extreme. So let's look at the M5. The previous higher high that capped the market, we had a break of structure here. And what led to that break of structure? This decisional and this extreme, which we can now push down to here. So we had 2 points of interest that was structurally relevant. Price has now done a inducement of Asia low, an inducement of this false demand, an inducement of all of this trend line. And now we are inducing into this decisional. So we are not really in a POI, but we kind of are too. We're in this odd decisional. It's not a confirmed decisional. We are in a weak decisional, which is why it's under the non-POI category. But we have induced significant amounts of things. We have induced an Asia low low, we have induced a point of interest, and we've induced London buyers. So we've had now a meaningful inducement, and we arrive to our key window. How do we arrive to our key window? We arrive to our key window with a trendline liquidity building up here to target, and more importantly, a local buildup of lows that is currently getting swept. So now we are building our trifecta of time. We're arriving to the minute of our time window. Lower time frame confirmation we need to find, and inducement. Have we found the inducement? Yes. We've induced POI, Asia low, and London buyers, and a minor inducement happening into our decisional zone. Now that we've got time and inducement, we just need the lower time frame confirmation to execute on. So what do? We wait for price to give confirmation, and there it is. This is now showing me that we've had a bullish break of structure here. Why? Because after this inducement that we found at the highs over here, based on this build up on this inducement, bearish break of structure, we had lower low, lower high, internal lower low, internal lower high, internal lower low. So let me actually correct myself. This is the break of structure, and this decisional was also a minor inducement based on the small build up, this inducement that led to the low. We could see an inducement getting taken out and a break of structure happening. So now that we've had that break of structure, we need to find a zone to execute upon. Now in this case, there's an imbalance here and there's also an imbalance here. So this one is going to give us about a 3 pip stop loss. This one's going to give us about a 6.5. So I don't like the 6.51. So what we can usually do in this zone is mark out the lowest imbalance, and that can be where we put a limit. That is one approach. You can put a limit, and therefore you will have a nice 3.7 pip stop loss, 3.6 pip stop loss, in which case your 1 to 3 risk reward is going to be right here at 10.8 or just 11 pips. You can take your take profit 1. Now, if your take profit 1 is basically to form an M1 higher high, and your average session volatility is 15 to 20 pips, taking a partial at 1 to 10, as long as you're not hitting stop loss, is basically going to happen. And if you take full profits at the 1 to 3, you can see the compounding effect of just taking these small trades, these small 1 to 3 reactions that really add up. So across about 30 trades, you can have a 34% gain with a 50% win rate. 30 trades is just a couple of months. With a couple of months of average performance, 50% win rate, small high probability reactions, and locking in your profit at a 1 to 3 on a session volatility, you can have great returns. This is not just theory. This is exactly how I trade. Whether you do it from this perspective at full volume at 1 to 3 or on the other one where you split it up, you're going to have similar gains. So make sure you download this risk management tool. You actually utilize it to your advantage and you take quality setups like this. Now, the other thing you can do is if you don't want to set a limit on the extreme, you can actually wait for lower time frame confirmation. Now, this is what we call a break test situation that's happening. So we had a break of structure. We are testing the high. And then if we get an inducement, we can start to look for lower time frame confirmation once again, or we just see that we had a buildup of liquidity here and we could take an inducement based execution. So I'm not going to take that one because that inducement based execution is going to put me at about a 6 pip stop loss. So still not my preferred. So I'm going to put a limit here. That's option 1. And the option 2 is a lower time frame confirmation. So now we can see that we are inducing this small trend line liquidity. We're inducing that test zone. Now that we are inducing it, it's almost tapping into this entry, but maybe spread would miss for it. Let's see the next candle. Okay, what do we see here? Price is respecting, and this is how I trade a 2-leg protocol. So now after price has done a inducement, we've done an inducement, we see a push high that fails to make a lower low, goes on to make an internal higher high. I can now execute on this internal 2-leg protocol, which is one of my entry types, and stop loss at the inducement. So now I can take a 3 pip stop loss, and my 1 to 3 now is going to be around the same area, and this one is going to be 8 pips. So both of these trades are well within my average session volatility. So as long as price doesn't now break through here, I'm most likely going to hit my 1 to 3, and I can lock in either 1.5% or 3% based on my system on the space of about 10 pips. High probability reactions, not massive swing trades, and these can happen almost on a daily basis, which is why your rate of return will far outcompete any swing trader, because for them to hit a 1 to 3, you have to follow 4-hour market structure, and it might take days, weeks, or even months. That's not the way I want to be trading, at least. So now here we have the trinity that we look for. We have an inducement that we speak about, minor and also POI based. So we've had a medium inducement of Asia low, point of interest, London lows, and then also a minor inducement. Inducement box ticked off. Then we have a market structure shift on the lower time frame and an inducement 2-leg protocol, lower time frame confirmation. And it's happening exactly in my key time window, pretty much to the minute. So I've got my trinity in place, and I've got my break-even protocol on a higher high, and I have my 1 to 3 partial points, and then shortly after that, price basically flies to that level. Now I've had my average session. This one was 13 pips. It's on the lower side of an average session volatility because we said it's 15 to 20 pips. Here we've had a lower volatile session, still hit our take profit level within the hour, within the session, and that could be you done for the day. That could be you even done for the week, because when we log it into our systems, that's exactly what we need. Small 1 to 3 reactions, and this is a lower quality trade because it's not even a point of interest. So imagine the power when you digest this channel and and you look at the multiple trade models we've taught on this channel, from A+ setups, prime setups, higher time frame aligned setups, major inducement type setups, we've given multiple guides on this channel so you can really dissect what's going on. And if you want to take this a level further, then click the link below this video, because we have a full 6-month incubator of real advanced implementation. Because I don't believe theory is enough. I believe application is the changes you need. I believe the real changes you get as a trader is based on application, based on implementation, based on practice, which is why we live stream 2 times a day, every single day. You'll get one-on-one personalized mentorship once a week. You'll get 2 live Q&A calls per week. You'll get daily videos, daily bonuses, guides, PDFs, case studies, a 1-year bank of content of live Q&A sessions, live streams, live training. We're doing it all in this 6-month incubator. And by the way, crazily enough, over the last year, we've had so many people go through this and not a single person has asked for a refund, because we've had many people get funded, many people reach payouts, and many people get over $1 million in funding. We're really changing lives out here. And of course, on YouTube, I can teach you stuff for free. But if you want to see real returns, real changes, and real knowledge and real application by live training with us, go ahead and apply in the link below. I'll maybe see you inside of a live session where we might be even trading together. And ladies and gents, as you know, as always, a restricted trader is a profitable trader.